Hello and welcome to Money Control. It's the earnings season, and we know that just looking at profit and loss account is not enough for you. I'm Rachita Prasad, and joining me today is Mr. Jayant Acharya, Joint Managing Director and Chief Executive Officer of JSW Steel. JSW Steel announced its financial results on July 21st. Mr. Acharya, welcome to Money Control.
Thank you very much. Happy to be here.
Mr. Acharya, your results were announced and quite an interesting set of numbers. Your bottom line has actually impressed everyone. It's almost three times what it was a year ago. There is a sequential decline nevertheless. Help me understand what has happened in this quarter and what went behind these numbers.
Yeah, so just to set the context a bit, I think global economic side, we see that while the challenges remain, it has been more resilient. World Bank has upgraded the outlook by 40 basis points. Declining inflation, lower commodity prices, lower energy prices have supported some part of the recovery in some areas of the world. India's economic momentum continues to be strong, driven by both business and consumer sentiments. We see both manufacturing and services doing well. The inflation is moderating, which is again a positive. The growth in India is supported by a strong focus on the infrastructure and construction spend by the Government of India. The manufacturing activity is also doing good. We also see a positive benefit of the supply chain realignment, which is taking place globally, which is favoring India. We see more FDI and FII inflows due to a better India outlook. Stable currency and creation of global capability centers in India are additional positives. If you look at the steel cycle, I think globally the steel industry has seen a slight moderation in production over the first 5 months of this calendar year up to May, and it's dropped by about 1.2%. While China went up by 1.6%, the rest of the world dropped by 4.6%. But if you look at India, I think India has done quite well. The first quarter has seen a growth of 10%, and the demand has risen to 30.3 million tons, which is a very strong first quarter performance. We expect that the growth will be in the range of 8 to 9%, which would incrementally mean 10 to 11 million tons, taking the growth overall to 120 million tons. Indians' demand in the first quarter has risen by 10% to 30.3 million tons, which is a very strong first quarter performance. We expect that the demand in India will continue to be in the range of 8 to 9% this year, which means about 10 to 11 million tons of delta increase, which is 130 million tons by the end of this year. India's demand is driven, as I said, by infrastructure construction, a good manufacturing. We see the renewable energy space adding more capacity. 45 gigawatts of more renewable capacity is expected to be added in the 2 years. Automotive is doing well. And we see a rising private consumption. So therefore, India's demand going forward, we see to be quite robust. China has been a little subdued in terms of demand, and the China production, elevated production, has resulted in more exports into the world, which is a cause of concern. However, China has given a direction that they would like to limit the production to calendar year 22, which essentially means that in the second half of this year, there would be a moderation in the production. So that should be positive for the global steel industry. And on the raw material side, coking coal prices, which were high in February and March, have moderated, while the higher coking coal prices of the last quarter, quarter 4, has flowed into quarter 1 into our cost. We expect the benefit of lower coking coal prices, as we see now, flowing into quarter 2 and the coming months. Iron ore prices have not corrected to the extent we expected. We do expect some softening in the iron ore prices in the coming months. Steel prices have by and large bottomed out. The channel destocking, which was taking place, have by and large been completed, and therefore we should see better buying in the coming quarter. Given this backdrop, JSW Steel has performed quite well in quarter one. Our EBITDA has been about 7,046 crores on a consolidated basis, which was 64% up YOY, and the EBITDA per ton at 12,345 rupees has been slightly better than quarter four. Our EBITDA margins have been 16.7%, and we expect that the lower raw material cost will offset to some extent the corrected prices which will flow into Q2. So Q2 also should see improved volumes with a, I would say, cost benefit which would offset the correcting steel prices.
Mr. Acharya, help me understand. You've given us a very comprehensive overview of the global macros and how JSW Steel is placed. Now, for the rest of the year, you said the second quarter also we will see some of these factors playing out. But in the Indian market, there are some concerns about inflationary pressures coming in, given the kind of floods we are seeing in India. What is JSW's outlook on that? And if you can kind of specifically tell me what is your outlook on price, production, and demand in the Indian market?
So inflation, I would say, if you were to look at the overall inflation numbers, while CPI has marginally moved up in the last print, however, wholesale price inflation has been down. The concern is the food inflation, which I understand. But I think while the monsoon has been uneven, it has improved over the last few weeks. As far as the overall manufacturing space is concerned and the price of steel is concerned, I would say that the prices in India we see have bottomed out, and the same is so globally. Global steel prices have also bottomed out. We therefore expect a range-bound pricing going forward, and it will be supported by I would say, a lower raw material price as we go into the coming months. So therefore, that should be positive. The demand is positive, and as we go into the remaining 9 months, we are quite hopeful that we'll be able to meet the guidance which we have given both for production and for sales.
What is the sales guidance again, Mr. Acharya?
It was 25 million tons.
25 and that million. You are hopeful that will happen?
Yes, we did add inventory of about 300,000 odd tons in this last quarter. Primarily, it was because of the cyclone towards the end of June quarter, which impacted some of our export shipments. It also impacted some of the sales to the western region where the cyclone impact was felt. So we should be able to liquidate this inventory in the coming months.
Mr. Acharya, the calendar year 2023 was very interesting for you. I mean, in the auctions, JSW bagged 6 iron ore and 2 coking coal mines. I mean, help me understand how does this fit into the bigger picture and how will it play out in terms of the timelines and the investments that you would have in mind for these mines?
Yeah, so we, as a strategy, we would like to have a raw material security, and iron ore is our most important raw material, and therefore we continue to look for assets which make strategic sense. We have acquired recently 6 mines, as you rightly said, and 4 of them we expect to operationalize soon. The other 2, which are in Maharashtra, would require some exploration, but efforts will be on to do that as early as possible. We will continue to look for more mines in auction which would come up, which would be strategically important for us, and continue to bid for those assets. It provides the raw material security and thereby would give us a benefit with respect to a better assured raw material, which enables us to plan our blend better because it is predictable in terms of iron ore going into the manufacturing process.
And what would be the total investments on these mines as such?
I'll give you that number. I don't have it off the
Sure.
Off the cuff.
Fair
But
enough.
we are investing both on the iron ore mines and two of the coking coal mines which we have picked up, which is giving us 1 million ton of clean coking coal.
And when you say that four of the iron ore mines will be operational soon, how soon is soon? What is the timeline here?
I think there are two mines in Karnataka which we hope to operationalize in less than a year. And in Goa, I think it would also be by FY25, so about the middle of next year, let's say.
Mr. Acharya, you have been doing a little bit of a restructuring within the group. You have completed the merger of JSW Ispat Special Products. You have actually you're in the process of doing that, if I'm not wrong, and you're targeting to complete it in the next 2 months. And what you have completed is the merger of Vallabh Tinplate and Vardhaman Industries with JSW Steel. Now, help me understand what is the bigger picture here in terms of what is the entity that you are actually trying to create here, and what kind of synergies would we see, and when would the benefits start kicking in?
So, our focus on our capacity growth is also complemented by the fact that we focus on our value added and special products. In the last quarter, also, if you see, the VASP was 61% of our total sales, and it grew by 34%. And what we have acquired in National Steel is again a value added product, which are coated products. And similarly, in VIL and Vardhaman in VTPL, which we have merged into JSW Coated, are all value-added products. So we would be scaling up the capacities at National to the full extent and integrate that backwards. So we expect benefits of that in terms of volumes to play out in this year as we go into the financial year 24. VTPL has been operating by and large on full capacity. It's just that we are doing the merger. It was under JSW Steel. We are merging it now into JSW Coated so that we have all the value-added coated business under one entity. So going forward, I think the coated business, we see a good demand, double-digit growth. This has the color-coated lines, it has the galvalume lines, it has the tin lines, and which all of them have a good visibility in terms of demand.
Mr. Acharya, I know you're in Japan right now. You're joining us from Japan, and you have a joint venture there with JFE Steel. A very exciting joint venture. Tell me what's happening on that, and by when can we see some interesting announcements on that front?
So our relationship with JFE is extremely strong, and we continue to have that going forward. We have entered into a joint venture agreement, as you know, which we had mentioned, for CRGO, which is a high-end electrical steel, which is technology intensive, which we'll be putting up in India in collaboration with JFE. Initially, the capacity will start with 62,000 tons per annum, and it will be scaled up. This will be the first facility in India which will produce the electrical steel in India and finish it in India. And we see a good demand because most of the steel, a major part of the steel is getting imported. Apart from that, we continue to collaborate with JFE on various areas in terms of benchmarking and in terms of operations, and we will continue to do that.
What about other joint ventures or acquisition opportunities? Do you have appetite for more?
So we continue to look for strategic assets, and I think NMDC has opened their data room, and we are looking at the numbers. We'll be looking at the values and then take a view. We will continue to look at assets which make strategic sense and fit for us, and then evaluate these assets. But in the medium term, we see a very strong opportunity to build capacities in brownfield. And we have 3 sites today in JSW Steel which can add brownfield capacities at very low specific investment, and that would be our focus priority.
So NMDC is definitely on the radar. That's interesting to hear.
I won't say it's definitely on the radar, but it's something which we had mentioned last time. So I just wanted to clarify that the
Sure.
data rooms have now opened, and therefore we are looking at the data. So we will not be able to comment with respect to any further interest on NMDC till we have the full data. But as I said, our brownfield ventures continue to be our focus area in Vijayanagar, Dolvi, and in Jharsuguda and BPSL.
Mr. Acharya, you have lots on your plate right now. On one hand, you have these new mines that you have won in the auction. You are also expanding, in your existing sites, brownfield expansions happening across your sites. That is happening on one hand, which requires more investment. And if you look at your net debt level, it has gone up to around 66,000 plus crore in the June quarter. I think it was around 59,000 odd crore in the last quarter. Help me understand what is happening. I mean, are you looking at reducing the debt? And given that you're still in expansion mode, how will you manage that aspect?
So our debt, if you look at our net debt to EBITDA in terms of the ratio in the quarter one, it is slightly improved over the quarter four. It's at 3.14. And while the debt in absolute numbers have gone up because the working capital investment has taken place in this quarter, we have put money into some of the inventories which increased, as I mentioned, in our system because the export shipments got impacted by the cyclone and some of the sales which were in transit to the west got impacted. Also, we paid back some of the higher cost coking coal, and therefore that has released some working capital, but that's gone into the debt. So we expect that these will, to some extent, revert as we come into the coming quarters. So we would expect that we will be able to manage our debt within a reasonable level and be well below the debt covenants which we have taken for ourselves, and still be able to carry out the expansions which we have planned. Most of the expansion capex which we have undertaken will get met from internal accruals and some part through debt.
So, if we were to look at your net debt level, you don't expect a significant increase in this current fiscal?
So the way I would like to put it is that there would be an addition to the debt from the point of view of the merger which will happen of Monet, AISPL into JSW Steel in this quarter. So that would add about 3,000 crores of debt. However, we expect that we will be able to liquidate some of the working capital which has gone into the business in this quarter. And therefore, the debt which you are seeing today in quarter one would come down as we go into the coming quarter. So we expect a better debt vis-a-vis what you see today as we finish this financial year, in spite of the fact that we complete our 9 million tons of expansion.
Mr. Acharya, the other theme playing out globally is the decarbonization theme. I mean, you already are looking at that space, but with the carbon taxes kicking in, how prepared are you for it? And do you expect, some initial hiccups to be there? What is the strategy on that?
So I think I would say that the decarbonization phase is something which we are quite serious about, and we are taking this in three phases. In the current first phase, we are taking initiatives which are doable in the medium term by 2030. And we have taken a target of achieving carbon dioxide emission of 1.95 per ton of crude steel by 2030. And the levers which we are using is that we would shift to renewable energy as much as possible, which is very much doable. We already have 1,000 megawatts of renewable energy under construction in Vijayanagar and some part in Dolvi and Salem. 225 megawatts is already operational, and the balance would get completed by this year. And we will add further renewable capacity. The second lever will be our energy efficiencies. We are improving our energy efficiencies in our steel plants and thereby save energy. The third lever is process efficiencies, and we are trying to improve our resource utilization in the system by using more scrap, by using beneficiation technologies to upgrade the iron ore, and thereby use lesser resources for the same output. We are also looking at circularity in a better way. We are trying to use different kinds of waste. We are trying to use scrap internally, which gets generated and put it back into the steel making, and the best available technologies which are available today. So with these 5 levers, we expect that we will be able to do well to decarbonize in the medium term and do 1.95 tons per carbon emissions per ton of crude steel or better by 2030. The second phase of decarbonization is the hydrogen and the carbon capture and use. I think these technologies are still evolving and yet to become commercially viable. We have taken a trial project on for hydrogen at our Vijayanagar Steelworks. We will be in collaboration with JSW Energy. They will be putting up the electrolyzers and the hydrogen supply with renewable energy. And we would be using that in one of our facilities to produce low carbon emitted steel. That would give us some experience, and we would analyze those studies to see how we can take that initiative forward. As the technology evolves, as battery storage systems and better technologies come in, I think we would like to adopt some of them and leverage them going forward. So that will be the second phase.
That's an interesting plan. I think between JSW Steel and JSW Energy, you have a solid plan. We'll definitely talk to you more about it going ahead. Thank you so much for your time. I know you have a busy day ahead. Thank you, and we'll be in touch.
Thank you very much, and pleasure to be here. Thank you.